And I'll add, I don't think you'll find a more contrary opinion. If you're looking for a contrary opinion as a way to have the majority fooled, which is what the market usually does. For example, everyone hated gold at $250. They love it at $1250. Very few people on the planet think that deflation is likely. You've got the bulls who say we're fine, it's a normal cycle, and you've got the bears who say hyperinflation is coming.
The problem with all those inflation, deflation arguments is definition. People mean different things by it. And
sadly, you'd think by now they'd have a definition nailed down.
Exactly. And so I'm wary about getting into those conversations without kind of agreeing a definition first. But just harping back to for a moment before we get into that, your call about triple digits on the Dow, I would suggest that the monetary system will implode before we get there.
I think it's begun imploding. That was the theme of Conquer the Crash, and it was before any of this began to happen. In fact, we had 3 more years in the U.S. of extreme credit availability right up into the peak of the real estate market in 2005. That was pretty much the end of it, though, 2005 to 2007. And now we're in a retrenchment period where credit is beginning to go the other way. Instead of expanding, it's contracting. Instead of people wanting to borrow, they want to pay off their loans. Instead of people wanting to lend, they'd rather have the money. And this is a psychological change. It's a social psychological change in mood and attitude. It's not going to go away. It's only going to get stronger, I think, over this period. And that is the ultimate cause of changes in the total amount of money and credit, particularly credit, in the system. And as credit implodes, as you say, that's going to essentially ruin or greatly disrupt the monetary system that we have, which is based on debt.
Absolutely. Now, yes, so...
Can I quote you on that? Absolutely.
Absolutely, you certainly can.
Okay, I mean, there's 2 of us saying the same thing then.
Well, I mean, I always agree with my guests. I find you get more out of them if you agree with them.
And when Mark Faber's on next week, you'll agree with him that we're going into hyperinflation.
Listen, my problem is when I hear an inflationist argue, I'm utterly persuaded by the arguments. And when I hear a deflationist argue, I'm utterly persuaded by the arguments. I'm easily swayed. But my kind of overall view really is that we're going to see both, and we are seeing both. We're seeing, if the definition of an inflation is an increase in the supply of money and credit, then we are seeing a growth in the supply of money because of quantitative easing and various other government policies, but we are seeing a decline in the amount of credit because of individual deleveraging, if you like.
Correct. It's exactly right, and my argument is there is far more credit than there is base money. 50 to 500 times, depending on whether you count promises such as Medicare, Medicaid, Social Security, and all the derivatives out there. But just the obvious, IOUs that people can see, the bonds, bills, and notes, they're $50 to $70 trillion worth, and in the U.S. we have a $2 trillion money base. So that's a very big difference. There's far more credit, and I think that implosion of credit is what is going to accompany this big decline.
Let's talk about what you consider to be safe assets, what you should be owning in this environment.
There are very few in the world. The monetary system globally has gotten in such sorry shape with so much bad debt out there that there are very few things that I believe are safe to buy. I would not want to buy long-term bonds. I don't recommend buying, say, in the U.S., state or municipal bonds. The stock market is terrifically overvalued. Real estate remains terrifically overvalued. There's an overhang of real estate, and the banks lent to the last possible person back in 2005, 2007. I don't think there's anyone left to lend to. So that narrows it down, and we're in a situation where gold would normally be attractive in a deflationary environment if it were the money we were using. Unfortunately, what most people owe are dollars and pounds and euros and yen. So that is what the scramble will be for. And I think this is why the dollar turned in November, because finally we have returned to a credit implosion situation and people are starting to worry. So they're rushing to buy the dollars that will survive. So what's safe? Nothing is purely safe, but the safest items are plain cash. I mean, like the kind you carry around in your wallet.
Yeah.
And you can store those in vaults. The closest thing to cash is a direct, full faith and credit of the government short-term bill. In the U.S., that would be a treasury bill. In Switzerland, it's a Swiss money market claim. And then I've always said it's a good idea to have some precious metals even during this environment. And I said that in Conquer the Crash back when gold was in the 300s. I think it's way overpriced now, and it's giving technical sell signals. So I'm not interested in adding here, but we're going to be looking very carefully to move to that investment later as the deflation ends. If everything goes my way, we'll be moving from cash to gold rather.
I have some people who've earned a bit of money and they've got some savings and they come to me for advice, and I've advised cash and gold.
Good.
And I don't think that's bad advice, even though gold was looking very frothy at 1,200, and there are some technical arguments that point to a higher gold price by the summer if it continues to repeat a pattern it's made over the previous few years, which is to make an up move of 6 to 9 months, then consolidate for 18 months, and then make another up move. And I think it could be that we're halfway through such an up move, in which case we'll see higher prices in the spring. But in an environment of capitulating stock markets, which we seem to be heading into, then I think gold will fall with the stock markets, at least at first. And then at a certain point it's going to decouple. I think you have to own some gold, because if we do go to those kind of numbers that you're talking about, or even 3,000 on the Dow, there's just going to be so much pressure on currencies, particularly for us here in the UK who have, with sterling, we don't have the senior reserve currency of the world in US dollars. That I just think you have to own some gold, and if it goes down, you just have to accept that it goes down and it has the potential to rise at some stage.
Yes, I agree, as long as the word some is in there. I think many people are saying this is the only thing you should own now, and I think that's very dangerous, because what's actually happening is the coupling is getting tighter and tighter and tighter. The stock market topped out in October 2007 in the U.S., and the dollar had not yet bottomed. It finally bottomed in March 2008 as the metals made a top. That's when silver made its top that it has not exceeded yet. And then it tested the low in early July, and that's when oil made its top. Mm-hmm. So it was spreading out over quite a period of about 9 months. Now, the dollar just bottomed, I think, in November, and then tested the low just a few weeks later in early December, and gold and silver appear to have topped at that time. It did a wave 1 up and a wave 2 down, and that's when the stock market finally registered a high. So if you look at how tight that is between November and January, I think gold and the stock market are more coupled than ever right now, because the big force is this deflationary force. We're heading into a third wave down. That means it's going to overwhelm everything. So I think people will be selling everything they can get their hands on to get whatever money they need to either pay their debts if they're on the debtor side, or to collect those debts if they're on the creditor side.
Mm-hmm.